Is this the year that you want to start taking your finances seriously and start to build some real wealth? Have you always thought that investing is only for the rich and there's no way that you can get started? Well, in this video, I'm going to break it down so that anyone, even those on a so-called lower income, can start investing today. What steps you need to take, how to maximize your returns, and a couple of pitfalls that you need to be aware of and avoid. Right, first off, all of these steps are much more about mindset and behavior than they actually are about doing anything specific. It's all about building a solid investment plan that actually builds your wealth over time. And the first thing you have to do, I'm afraid, is pay off any consumer debt, any high interest debt that you've got, any store cards, any credit cards, any personal loans, any car loans, anything that doesn't appreciate or grow your net worth and costs you more in the long run. You need it paid off. These will be debts that we would describe as bad debts. So there's good debts as well. So a good debt is anything that appreciates your net worth or value over the long term. So a mortgage, for example, typically the value of property goes up over time. So that sort of mortgage debt is a good debt. So debt that you get into that enables you to go to university, student loans, any debt associated with that is going to potentially increase your returns over the years. So that is a good debt. Taking out a credit card and buying a load of stuff and not paying it off in full, that's bad debt. So I'm afraid that brand new 65-inch OLED TV you've got your eyes on, it needs to go. Can't afford to buy it in cash right now. That means you can't afford to buy it. And if you've got any consumer debt left over from before, where you haven't really been tackling your finances properly, now's the time to put a plan in place to get it paid down as quickly as you possibly can. And this is what I'm talking about from a mindset perspective. It is not easy to pay off debt, and sometimes it can look impossible or it's going to take forever, and what's the bloody point? I've been there, and it took me years to pay off the consumer debt that I had, and it was hard. I got married in my mid-20s, and we haven't got wealthy parents, unfortunately, so we paid for our wedding on credit cards, believe it or not. And it took me years to pay that off, years to pay it off for one day. But as soon as you get that last payment done, and as soon as you become consumer debt free, there is no better feeling in the world. It is the most liberating feeling ever. Yes! That's awesome! Now, step 2 can be done in parallel with step 1, and it is to grow your disposable income. UK minimum wage is $17,374 per year. Now, after all your expenses and bills are paid, that does not leave a lot of money left over for investing. But the reality of the situation is it is far easier to grow your income, to grow the salary that you have, than it is to just shave off £5-10 here a month. Once again, it all comes back down to mindset. So the mindset of someone that is trying to grow their salary, that is trying to get that next promotion, that is taking these things seriously and is starting to pull together a long-term plan about how they can increase their income over time, perhaps going up the ladder in their existing business or whatever it is, going in a completely different career, starting a new job in an industry that you never even thought about before. That sort of mindset is going to be far more powerful than the mindset of someone that's going to not have that luxury once a month that costs them 15 quid a month, whatever that may be, because at the end of the day, you've got to keep a few luxuries, otherwise what's the point of all of it? Step 3 is the last thing you need to do before you can start investing, and that is around building an emergency fund. And this is no set rule for anyone, whatever makes you comfortable given your specific circumstances. So it could be that you still live at home with your parents, therefore you only need a couple of weeks worth of emergency cash in the background. Or it could be that you're a family of 4, you pay all the mortgage and feed everyone, therefore maybe you need as much as a year. I don't know, it's different for everyone. The general rule states that you need about 2 to 3 months worth of bills covered, and once you get to that point, you can start to feel a little bit more comfortable. It's just going to enable you to have a bit of a buffer should anything happen to the income that you've got coming in. So you've got no credit card, you've got a plan to increase your income, and you've got some cash on the side. Now, you are over halfway there. If you reach this point, life just gets so much easier from here. And for a lot of people, it will seem almost impossible to get to even this point. So if you do get to this point, and it has taken you a lot of hard work and it's taken you quite a while to get there, you need to recognize that. You need to go easy on yourself and say, I've achieved a lot here by even getting to 0, because at this point you're now on the cusp of changing your life forever. And now it's time to start investing. Warning. Now there's all sorts of different ways of investing, and so many people, you can see articles all over the place of people, often kids, that have made a fortune from crypto or NFTs or whatever it may be. YouTube is even full of scammers asking you to invest in the next big thing, or they've got a system that helps you beat the market or whatever it is. All you need to do is send them £1,000 and they'll show you step by step how it's done. But you must be aware of these shiny glittery get rich quick schemes. More often than not, there are hundreds of times more losers than there are winners. And that goes for all of these crypto meme coins as well. We're very, very unlikely to get rich going through one of these schemes. In fact, you are very, very likely to lose your money instead. So how should you go about investing? And I've got 2 words for you here: index funds. So index funds are basically a big bunch of businesses all wrapped up in a lovely little lower risk package. The S&P 500 is 500 of the biggest companies in America. It is constantly being updated, so you've always got the 500 biggest companies in there. So if one drops out, one comes in. All you need to do is go into a reputable platform just like Freetrade, go to the search box, type in S&P 500, and it's going to give you a list of indexes. So indexes are basically just funds that track against the S&P 500, those 500 big businesses in the US. Open an account with them, use the link below if you like. You'll get a free share up to the value of 200 quid and just start investing. And anyone can do this. The fees are really, really low. It doesn't take much capital to get started at all. You can just drip in pounds. You can drip in a few pounds just to get you started. And it has been proven that people who invest in index funds outperform 90% of amateur and professional people who invest into individual businesses. So you are far more likely to get to maximize your returns by investing into index funds. Index funds are great because they also give you diversification. So this is diversification. Even with the S&P 500, you get diversification across the globe because all of these businesses have got presence in pretty much every country in the world. You've also got diversification across sector or industry. So within the S&P 500, you're going to have tech businesses, pharma businesses, all sorts of different businesses that will spread the load, spread the weight, make it safer, but also maximize your returns. Diversification is really important because if you, for example, took £1,000, invested it into Tesla, and it dropped by 50% over the course of a few weeks, you're down 500 quid, you look at it and you think, what the hell is this stock market business all about? And you never invest in it again. Whereas in reality, that could really genuinely happen. Over the last couple of months alone, a number of growth stocks have dropped by 50%. A number of businesses I'm invested in have dropped by 50%. However, the S&P 500 has grown in that time frame. Now, the younger you are, the better it is for you to start investing as soon as you possibly can. Now, let's look at an example. If you're 30 years old, for example, and you can invest £250 every month for the next 25 years into an index fund, and you don't touch it, in 25 years time, it's going to be worth £400,000. Now that might seem like ages away, but that time is going to pass anyway. So you might as well be investing. Also, if you can continue to grow your wage even more over that time period, and you can continue to start dripping a little bit more in there, obviously your returns are going to do the same. They're going to grow. Before you know it, you're playing around with the maths, and all of a sudden you realize you can make £1 million quid. As crazy as it sounds, it is real. It is within our grasp. It just takes time. Once you do start doing it, you start getting hooked. You start thinking of creative ways around you can plow more into here, whatever it is, side hustle, or start going after that promotion you never thought you wanted to do, or you don't buy that 65-inch TV. Instead, you put 800 quid into an index fund, and it just snowballs and snowballs from there. Now, once you've started investing in index funds, naturally, the temptation soon comes in that you want to start investing into businesses, and that's not a bad thing, but you just need to be careful about how you go about doing it. This is a riskier approach. And you must allocate money that you're prepared to lose pretty much in this area. Don't forget, people, as I said before, typically underperform the market. The index is the S&P 500, so you need to be aware that the risk is far higher, but the rewards are higher too. And how you go about this is making sure that you research the businesses that you're going to be investing into. You must also diversify the businesses that you're going to be investing into. Don't just pick one. So this is my dividend portfolio within Trading 2 and 2. In here, I've got geographical diversification across the world. I've got businesses that cover most different industries as well. I've got all of this diversification that enables me to maximize those returns. We're looking at farm, tech, finance, REITs, all sorts in here. That means that actually this is a really safe dividend portfolio, as far as I'm concerned, from my risk anyway. Individual stocks in, very attractive, but far riskier, so you must make sure you do your research. And if you don't understand it, don't invest in it. There's 2 different types of research that you must do, and the first one is quantitative analysis. This is analysis that looks at cash flow, balance sheets, income. So this is all of the numbers associated with the business, and you can find all of this information. Just go to Google, type in the name of the company, start looking into some of the press releases in terms of their numbers, in terms of their financial reports, and you can find out all of this on businesses that are listed on the stock market relatively easily. The second is qualitative research. Qualitative comes from quality. So what is the quality of the business? What is it that they make or do? Do they have a good, bright future ahead of them? Are they in an area that you think is going to grow in the future? Have they got management that you like to look at? what management do you like, the way that they speak, the way that they communicate. You might look at a sector and think, wow, this is going to blow up in the next couple of years. For example, a couple of years ago, imagine if you'd looked into Deliveroo and Just Eat and you thought, well, hang on, everyone's moving into having all of these takeaways. They're expanding, they're getting new sign-ups all the time, they're starting to get into grocery. This is going to grow. So that is qualitative research. You're thinking, this one's got a future. So if you'd have put some money into those two businesses a couple of years ago, you'd be doing all right by now. So what is the next one of those that are coming along? Now, once you've got the hang of this, you can start looking at different sorts of investments in terms of property, or investing in businesses, or investing in startup businesses. Now, once you get to this point, it gets a little bit more complex and you need a bit more capital up front to be able to do it. It's higher risk and it's also higher return. I'm not at the point where I'm starting to do that yet. That's the next step for me. But that is a really exciting potential opportunity then to really then diversify the portfolio even further with some of these really interesting approaches. One of the key things around all of this is you've got to surround yourself with positive people. You need to get rid of negative people. If there's people in your life, if you've got friends that are holding you back, that are telling you you can't do it, that are telling you stock market's for idiots or whatever it is, they're always on at you saying that things aren't going to work out, or just generally negative people, you need to try and get rid of them. You need to try and find some positive people that are going to help influence you to do the right thing, to push yourself forward. Get into Instagram and find some people on there that have got a really positive mindset. Start communicating with them. I'm on Instagram, follow me. Let's have a chat in the messages there. Get onto Facebook, find some good groups. Get onto YouTube, find some reputable YouTubers that are really talking about the stuff that's going to help you progress yourself and move forward. Positivity is key. It comes back to this whole mindset thing. If you've got a positive outlook for this sort of stuff, you're going to maximize your return. If you are interested in investing into dividend businesses, I've got 5 right here that I think are going to be pretty good in 2022.